Welcome to the Monday Futures Market Outlook for December 3rd, 2012. This is Patrick Ceresna. For those of you interested in learning about trading throughout the mornings live in the S&P Futures trading room, complimentary memberships are available on our website. In addition, all of the intermarket analysis that we do is published in writing and in greater detail in our Market Timing Strategist newsletter, including specific market forecasts, assets, and different stocks from which you can own. To learn about subscribing to the Market Timing Strategist newsletter, visit the website. As always, we start off with a chart of the US dollar index futures. We've changed our risk reward proposition to poor several weeks ago as we were seeing the US dollar coming off its overhead resistance around that 81.75 focal point. At this juncture, we remain of the perspective that there's room for the US dollar to continue to deteriorate back down to its previous lows around that 78.75 level. But even if it was to deteriorate even further, we could see a trend in the many months that could see it come back and retest bigger picture lows down toward the 77 to 75 levels down below. At this stage, there's no reason to believe that the US dollar will change this trend on the short term, so we're going to stay with that stance for now. Next, I want to take a look at the Euro FX futures chart, and what the Euro shows here is something that we've seen across all cross currencies against the US dollar, which is continued strength on a lot of global currencies outside of the yen. And really at this stage, this trend is in place, and we still believe that is a bigger picture trend that can continue developing this way. If the US dollar weakness does come to fruition, we could see a euro that not only strengthens back to the 131 to 132 area, but we may see even early next year testing of even the 133 to 135 levels above before a bigger picture turnaround can develop. Next year, I want to take a look at the 30-year Treasury bonds, and we continue to see bonds surprisingly hovering near their all-time highs. And this is going to be a very interesting moment in the market because a lot of this chart doesn't look bearish. It just looks very heavy along the top side. But if we continue to see strength in commodities and weakness in US dollars, inflationary pressures may force interest rates on these long end of the yield curve to start pricing in that inflation, which could see reversals in these bonds. So while the trend is higher here and many indicators and other things point to bonds to move potentially up, we think that the overhead resistance is substantial, and we think that any rallies may be short-lived. Next year, I want to take a look at copper futures, and copper continues to strengthen off of its consolidation lows. Really at this stage, with copper having held the 342 level, we believe it's very natural for copper to come and test the top end of the ranges, and we could probably in the first quarter of next year see prices back at 380, 390, or even $4 on the upside. Next year, I want to take a look at the E-mini crude oil futures contract, and I drew in a little trend line here, but crude oil actually has a very similar chart pattern to that of copper, and while copper has broken out, oil still has been more or less hovering in this 86 to $89 kind of range. We do believe there is room for crude oil to strengthen here. The consolidation for most of the month of November really has put in some short-term lows, and so long as US dollar weakness and commodity strength is evident, crude oil can strengthen easily back up to the 92 to $95 area, and if given enough momentum can easily return back to even $100 on the upside at the top end of the range. Next year, I want to take a look at gold futures, and gold has sort of been a mixed bag here. Even though a lot of the other commodities have strengthened, gold has sort of traded a little bit sideways around the 1700 level, give or take. Really at this stage, we still are optimistic and bullish gold, but gold may not necessarily go up in a straight line from here. If this ends up continuing to deteriorate in price or like it did in the last week, there is a vulnerability for gold to retest the lows that it put in just a month ago. We could see another low coming anywhere in the 1650 to 1700 level, and then after putting that in, would allow gold to rally higher. One way or another, we're optimistic and bullish gold could go higher, but simply pointing out that short-term pullbacks may occur. So finally, when we take a look at the S&P 500, we have a very material progress higher. The 1400 level was sort of a shorter-term retracement level that was an obstacle, and we were able to very easily exceed it last week and continue to consolidate above it. What we want to focus on here is that we're going to be bullish this market so long as the bulls can prove to be buying the dips. Every time we've seen 20 to 40 S&P pullbacks during advances, the market will immediately come back and the buyers will use the short-term weakness as a reason to accumulate. We want to be seeing that exact pattern developing here, and if it does continue to develop that way, we will remain distinctly bullish, looking for a Christmas rally into the year end. And so really at this stage, as the S&P 500 trades up along these zones here at around the 1420 level, even if pullbacks to 1400 or 1390 occur, and then subsequently are accumulated in weakness, then we will still remain distinctly bullish for our year-end rally. So very quickly, just to review the key intermarket observations, we are right now believe the US dollar risk-reward proposition continues to remain poor. That certainly will allow commodities to come off of their bottoms and many of them to continue to rally. In regards to bonds, because of that pressure, and if that storyline that we built on the US dollar commodities continues to develop, then bonds represent a very poor risk-reward proposition up along these all-time highs here. And so while the one thing we want to point out with the bonds is that they are very distinctly uptrending, and so we have not yet seen a change of the uptrend, and so the risk reward of poor is not because it's in a downtrend, but rather because we feel that the upside is marginal for the risk of owning it. In regards to stocks and global stocks, particularly when we're talking global stocks, a lot of the Nikkei and other markets like that have really shown signs of bottoming and reversing. We're looking to see whether or not this trend continues. We think that the stock market had its correction, that 6, 7, 8 week correction that we had, and there's room for the market to continue to advance into the new year. That was your Monday Futures Market Outlook. Thank you for joining me.